Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And with the markets up there at all-time highs, lots of stocks out there are expensive, but this actually brought sort of an opposite question to my mind today. Is it really even worth selling covered calls on inexpensive stocks, those lower price stocks? Is there anything to be offered there for an income trader? That's what we're going to be talking about today, the potential pros and cons of selling covered calls on lower price securities. A lot to address, but before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there on YouTube. Always good to see my very familiar friends out there. Hi there, Alex Markev, Eva, Mark, Life in the Fast Lane, Scott, Will, Bill, Andrew, Jay Richardson, everybody else. Thanks for joining us week after week. We always really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, well, enjoy that recording, but be aware that you're invited to join us in this live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern. We'd love to have you here. Also, my very good friend, Brent Morse, is going to be hanging out in the chats, addressing any questions that I can't get to from the live audience. Brent and I have now been working together for more than 2 decades. Hard to believe, Brent, but thanks for having my back there. And also, if you have an account with X, you should be following your favorite presenters from Schwab on X. It's the best place to connect with us in between these live streams. You can find Brent on X at Brent Moore CS. You can find me there at Cameron May CS. But let's get into this discussion of selling covered calls on lower priced stocks. But as we do, we need to consider the risks associated with trading and investing. Risk is real, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set out an agenda for what we're going to be covering today. First thing that I want to do is take just a minute to see what's going on with the S&P 500. And as I've already mentioned, as a spoiler alert, we're sitting at all-time highs again. And so in that sort of market conditions, there are some traders, including income traders, who may look to a strategy that is bullish. And a bullish strategy that we frequently discuss is covered calls. Obviously, short puts, another strategy that we discuss in this webcast series. Today, we're talking about covered calls. But with prices all the way up there at all-time highs and lots of stocks stretching the budgets of many traders, some may look to the lower price securities and ask themselves, well, is it even worth doing covered calls on these low price stocks? So we'll look at the markets. We'll set up an example covered call on a lower priced security, and that we're going to weigh the pros and the cons and go ahead and place a trade. Now, if time permits, I also want to take a look at existing positions within our example paper money portfolio, because this webcast is part of an ongoing series on trading covered calls and short puts. I think there'll be time. So we'll have a look at those at the end, but let's go right to Thinkorswim desktop, see what's going on with the S&P 500. And you can see, yeah, we have just kept pressing higher and higher and higher. And we're a fraction of a percentage point off of today's intraday highs, which were all-time highs again on the S&P, breaking records. Right now we're at 66.11, up 0.4% on the session. But for some traders, they may turn to bullish strategies. Now, covered calls they are bullish at heart. They're a little bit less bullish than some strategies out there, but maybe an income investor, let's put ourselves in the shoes of a trader who's looking for income. And maybe they're looking to sell some premium on stocks they own, but they turn to their portfolio and think, I just don't own very many high-priced stocks, and it seems like that's where the highest premiums are. Is it worth selling covered calls on these lower-priced securities? Well, let's go to an example stock and weigh whether a trader might consider this or not. Now, this is not a sales pitch for any strategy, including selling covered calls on lower price securities, but we just need to make informed decisions. That's my effort here today, is to help the viewer weigh the pros and the cons for strategies like these. Let's go to Bank of America. All right. So here's BAC. Let's put ourselves in the shoes of someone who maybe owns shares of Bank of America. It's only $50 stock. Lots of stocks out there are multiples of that. They might be up to their $500 a share, $1,000 per share. And if we do the math on that, a $500 stock like Microsoft, how much does it cost? How much does it tie up in a trader's portfolio just to do one covered call? $500 stock, 100 shares, that's a $50,000 commitment. We want two contracts, that's a $100,000 commitment, and it's in scale up very quickly. But here we have an investor who maybe owns a stock that's not quite so high priced. Maybe they own Bank of America and they note that recently it seems like it's been struggling to get much above about $51. You can see that over the last 3 weeks, we've touched that 51-ish level several times. And so the stock really hasn't been delivering immediate capital appreciation returns. So maybe the trader is thinking, well, if the stock isn't going up at the moment, maybe this is an opportunity for income. So I'm going to sell an example covered call on Bank of America. But as I do that, I do like to just give a quick touch, just a quick recap of some of the considerations that might lead a would-be covered call trader to stock ownership in the first place. Now, it could be their view of sector strength. It could be their view of the fundamental strength of the company. But some considerations that tend to be sort of not entirely universal, but very common are the price per share considerations. Yep, buying 100 shares can be expensive for those more expensive stocks, higher price stocks. The liquidity of the stock. Illiquid stocks tend to have illiquid options, which can have wide spreads between the bid price and the ask price. And when we try to get into or out of a contract, it can get stickier. They can be harder to trade those profitably. So let's say that our trader is paying close attention to price per share on shares that they're considering buying or selling covered calls or otherwise. Maybe they're paying close attention to liquidity, but also there can be chart considerations like this little premise that I just outlined saying, maybe we're bumping up against a price ceiling. Okay, let me just have a quick look at the chat questions here as we go to build this example covered call. All right, looks like just a little bit back and forth. That's totally fine with me. Terrific. I appreciate the discussions that our attendees have, but it doesn't look like there are any questions that I need to address specifically. So as we go to sell a covered call here, one thing the trader might do is just take a peek out on the horizon and see if there are any big events that might be upcoming. And there is an earnings announcement out here for October 15th. There's an earnings announcement for Bank of America. Let's say that our trader prefers to not have a covered call in place on their shares at the time of earnings, because one of the trade-offs when selling covered calls is it does impose a conceptual ceiling on how much the trader can make for the period of the contract. So maybe our trader just prefers not to have a ceiling on their stock in case the earnings go really well. They're accepting the downside risk of stock ownership, but they also want the full upside potential. So we're not going to do a covered call over the earnings for that reason. Not that everybody does it that way. So let's look at maybe selling a call before that. Let's go to our trade tab. And the first question we want to address on this lower price security is it worth it? Are there premiums even to be collected that a trader might consider? Now, the short answer for some stocks is yes. I can't say that universally. There are actually going to be some stocks where there's just not much premium there. But let's look at Bank of America. I'm going to go out here to the 10th of October. That's pushing this contract as far out as we can go, but keeping the expiration before that 15th of October earnings announcement. So if we go to the 10th of October, stocks trading at about 50.5. What if we were to look to sell a call? What if we look at the one that's just above the current price? Look at that. There's actually one at $51. And if you remember, that price ceiling appeared to be 51. It looks like over the course of the last several weeks, we had several touches along that 51 level. So how about we use this as our example? And this looks like on our $50 stock for contracts that are only for 25 days. This is not like going way out in time. It's not days from expiration, but 25 days till expiration, less than a month. That's about 2% of potential income on offer from this example strike. So I don't know, Does the trader consider that to be quote unquote good? Obviously, we have to consider how much premium is being collected, the time frame that we're under contract if we decide to hold this till expiration, and the limited upside potential now for the stock. So there are pros and cons. But if I were to summarize for traders who sell covered calls on lower price securities, there are a couple of things that might attract them. Number one is that the stock just doesn't cost as much. We can pursue covered calls at a lower price point. Now, another benefit is actually on a percentage basis, there are actually quite a few stocks out there that offer higher premiums than the higher price stocks. I want to do this comparison here. Let me do a quick comparison. If we look at this, we own the shares conceptually. Let's say we're able to buy them for $50.50 or something like that. And then we enter into a contract where we now have the obligation to sell those shares for $51, a little modest profit if it gets assigned. But that's it's a shade over $1 collected per share. We'll call it 105, right? Just keep that number in mind, 105. Let's say we were able to collect the 105. Now I want to compare that to a much pricier security. As a matter of fact, it's the one that I mentioned earlier, Microsoft. What is Microsoft trading for right now? Microsoft isn't a $50 stock, it's a $500 stock. It is literally 10 times the price of Bank of America. It's actually slightly more than that, but about a $50,000 obligation to sell covered calls. Now, this might suit some portfolios just fine, but you would think, well, if I were to throw this question out, which stock do you think offers a higher premium on a percentage basis, Microsoft or BAC? I think there might be plenty of people who say, well, yeah, Microsoft, it really gets up and moves. It's just one of those technology stocks. Don't technology stocks always pay higher premiums than like these boring bank stocks? Not necessarily. Let's investigate that. Let's go have a look at a similar option on Microsoft. So if you'll recall on BAC, we were looking at buying the stock and selling just out of the money. That was giving us about that 2% premium, about $1, maybe $1.05. So if we have 10 times the cost of the stock, and we're doing a similar contract, shouldn't the trader expect this to be at least a multiple of 10? We should be seeing at least, let's say, $10.50, maybe even stronger. I don't know. Let's go have a look. Look at this. This is actually quite competitive. I think a lot of eyebrows would be raised to say, on a percentage basis, Microsoft and Bank of America are pretty much paying the same premium. Paula says, is there a tool that can give this for all stocks? I'm not sure quite what you mean by this, Paula. Yeah. Oh, which one gives the best premium? Now, best is that's a loaded term. Higher, lower, I can say that. I can say confidently, well, this one's a higher premium, this was a lower premium. But best, we just have to be aware that there are risks associated with both of these. And one trader might say, well, this is the best premium, and then they lose more money on the stock at the same time. Doesn't turn out to be best. In any case, these premiums are both very, very similar. And I think for some, that might be a bit of a surprise. So if someone's asking themselves the question, is it even worth selling covered calls on a lower price stock? Well, on a percentage basis, these are essentially the same. So the answer there, at least with these two examples, at this moment in time, could be yes. All right, so let's go back to Bank of America. Let's bring that back up here, BAC. And close up the 17th of October. That one will be out beyond that earnings announcement that we're trying to avoid. Let's go back up to our just out of the money premium there. And I do want to address some of the other, let's say, potential drawbacks, the considerations, the risks of doing covered calls. Some are going to be relatively particular to the lower price stocks. Others are just sort of more universal to covered calls in general. But yeah, the lower cost of the stock could be attractive to some traders. The higher premiums may be attractive to some traders, but that lower cost on the stock, low price stocks also tend to have greater volatility. And that can actually account for the higher premiums. Premiums are influenced by volatility. So at the same moment the premium's going up, we have to acknowledge that that's likely due to an increase in market risk. So Mark says premiums may be similar, but the cost of the covered call is much higher with Microsoft. Yeah, Mark, so there's a larger commitment on, in other words, to buy 100 shares of Microsoft costs 10 times as much, $50,000 versus the covered call on Bank of America, about $5,000, right? But be aware that higher volatility that doesn't come along with every lower price stock, but lower price stocks in general, as a broad statement, tend to have greater volatility. Now, there also tend to be just fewer strike prices to choose from with what a trader might consider to be a considerable premium. So, for example, on Bank of America, this strike price that's closest to the current price, there's about $1. But as we even go $1 or $2 or $3 out of the money, you can see those premiums dry up very quickly. With Microsoft, there would probably likely be 5, 6, 7, 8, 9 different strike prices with premiums that may still be worth it to the trader. When we have very small premiums, what starts to play a larger role? So this is another consideration with low-priced stocks and their lower-priced options. Well, if we're collecting a small premium, we still have to pay commissions on that. So paying a 65-cent commission on a very large premium or paying a 65-cent commission on a very small premium, commissions can actually play a larger percentage role, have a larger impact on these small premiums. So let's put that into sort of real terms right now. If we're to sell this $51 call, collect, let's say, just over a dollar per share, that'd be about $100. And if we're paying a 65-cent premium, it's not 65 cents times 100 shares. It's not like we'd have to subtract $65 out of this, but we take 100, let's say $105 minus 65 cents means that the premium collected might net at 104.35 as an example. It does chip into that. Now, it's nice to say, even with these lower priced stocks, with their lower priced options, how many of you were trading or investing back in, let's say, the 90s? Can anybody remember when premiums used to be really high, at least compared to what they are right now? I was a broker back in the 90s. Just think about a normal, what you would consider to be a traditional stockbroker. And I can remember just taking a phone call, placing a trade for somebody, and it was a kind of a higher price stock for a good number of shares, about $100,000 transaction. And that trader, that wasn't really a trader, just an investor, I remember that the commission on that trade was $1,200 just on one stock trade. Just placed it, took me 10 seconds. Yeah, things have changed dramatically for the better for most self-directed investors, at least on that commission front. But it doesn't mean that commissions are no longer a consideration. And on low-priced stocks with low-priced options, those commissions can still play a proportionally larger role. Okay. Hope that makes sense. Now, another thing that we might consider as let's map out this trade. Let's suppose that we do sell that 10th of October. We're looking at the $51 call. And let's say that we're able to collect. Yeah, I'm going to still be generous and say that we get $1.05 for this. It looks like it might have slid down a little bit from that. What we're doing here is we're accepting a payment conceptually of $105 or $1.05 per share on 100 shares. But in exchange, someone has the right to buy shares from us for $51. And that right extends all the way out through the 10th of October, or as long as we choose to remain in this contract. With the volatility that tends to be inherent to lots of lower priced securities, it doesn't take much of a move to put a contract in the money and to elevate that risk of early assignment. So again, to put that in more real terms, let's go to our chart. Let's draw in a line here at $51. Let's carry that out. There's $51. Let's carry that out to expiration out here. And if you look at where the stock price is right now, you can see it wouldn't take much of a rally, a single day, a couple, to put that solidly in the money, raising the risk of early assignment if the trader is concerned about that. If we bought at $50.50, like it's priced for right at this moment, and we wound up selling for $51, that would be a $50 or 50-cent realized profit on the stock ownership, in addition to the 105 that we had previously collected. So that would be about $1.50 or $1.55 profitable exit in the case of assignment. So it's a risk of realized gain, but the other risk is we're limited to the upside. We might have to sell those shares at a price could be considerably lower than the current price at the time of assignment. So let's see. Considerations: smaller premiums means that commissions can have a higher impact, fewer strikes to choose from. Assignment risk can be greater due to that stronger volatility. And maybe a final observation. This is the way some traders think about this. Not everybody's going to agree with this next statement, but that is, do you ever look at a stock, you say, well, maybe it's $50 for a reason. Is it possible that those lower price securities, those lower price stocks, are just lower quality stocks? That's a possibility. Some traders will make that argument on a case-by-case basis. They may have a point, but for some, they just don't. They don't like doing covered calls on lower price securities because they have a personal objection to trading what they perceive to be a lower quality product. That obviously, that's a big thing to say, and it's not going to apply to every stock, because there could certainly be some very good companies out there that are lower priced. There could certainly be some very flawed companies out there that are higher priced. All right, but let's put on this trade. How about let's go ahead and do a covered call here. Let's say that our trader has weighed the pros and the cons, and they say it, in my case, maybe it is worth spending the $5,000-ish, $50 per share, to sell a premium for, let's say, $1. Ricebird says, I will always critique when price is low. Does it raise some of those alarm bells for some traders? It can. Okay, or high. Okay, good. Not just going to, let's say, trust a stock just because, other people have driven price to a higher level, right? Okay. But let's say that we're okay with placing this trade, and I am going to sell this strike that's right at $51. But it does require stock ownership. This strategy requires stock ownership, and the question often arises, well, when do we pull the plug? Well, if the stock starts to fall while we're waiting for the 10th of October, and the trader just waits and waits, and the stock just collapses in value, we have exposure to that downside. And this 105 premium that was collected might help take a little bit of the sting out of that, but 105 is the most help that it can provide. So for some who are getting into this income strategy, maybe they're okay with being patient if the stock is uncooperative for a while, but if it really starts to break down, maybe they pull the plug on that. And let's say that our trader looks at this, and we note, for really all of the last 12 months, the stock stayed below, it looks like about $49. Let me draw in a second line here, around 49. Well, there was one day, did we get above 49 and stay above 49? No, we didn't. We poked our heads up above it. But if you look at that $49 level, for the first 11 months of this last 12, that was a price ceiling. Finally pushed up and through that $49 level on a really strong candle day. And since then, that's been a pretty good price floor. Let's say that our trader has determined they're willing to go for that dollar of reward as long as the stock remains above 49. If it starts to break down, maybe they're concerned that the entire trend of the stock is at risk, and they don't like the downside exposure anymore to stock ownership. How about we put a stop on this? Let's give it 1% below that 49. Let's go at 48.50. All right. So here's how we might place that trade. Let's go to the trade tab. Let's first of all of this is hypothetical. We don't actually own 100 shares of BAC at the moment. So let's buy 100 shares of BAC, sell the $51 call, and then put in a stop to get us out if the stock starts to misbehave, drop down below 48.50. So here's how that might be done. Let's go to our $51 price level. I'm going to right click there and put in an order to buy a covered stock. Okay. What that does is it brings up an order to buy by default 1,000 shares of stock and then sell 10 contracts. Let's dial this one down. I'm not going to dial it all the way down to just one, but how about if we just do, let's see, in this webcast series, we've gone up to about 5. Yeah, let's get it down there just about 2 contracts. Let's say that we're willing to commit to a $10,000 share purchase and then try to collect a couple $100 in income here. All right, so that's going to, if we dial this down to 2 contracts, it'll match it up with 200 shares purchased. And it looks like if we buy the shares for $50.50 or right around there, and then we collect around $1 in premium, that would bring our net debit down to about 49.5. Let's say that we're willing to spend a little bit more than that. I'm going to dial this up and say that we're willing to spend up to $49.55 just to try to get this order filled while the webcast is going. Now, I also mentioned that maybe the trader wants to pull the plug if we happen to fall in stock price down to 48.50. Maybe at that point, we want to buy the contract back for whatever it costs to get out, probably less than what we received for it, but whatever it costs, and then sell those 200 shares. Here's how we might do that. Down here where it says advanced order, I'm going to change that from just a single order to my first order triggers a second or a sequential order to go into effect. This is going to be my exit order. So if I choose this, change this to first trigger sequential, I can now right click on the entry order and create an opposite or an exit order. Now with this one, we're going to come over here to the little gear icon and add a condition to this order, the condition being the stock price falling to 48.50. So here's what we're going to do. Down here under conditions, we're going to click under symbol, and it'll automatically populate with BAC. Method is if the market price of BAC falls to less than or equal to, let's type in 48.50. That's our condition, but what do we want to have happen upon that condition being met? Well, we want to sell these 2 covered calls. Now, the thing is, we don't know what the price will be to get out of everything, to buy the calls back and to sell the stock. So we're just going to put in a market order. That good till canceled. All right. So let's click save. So we're going to look to try to get in. Are we still in good position to get in? Yeah, it looks like around 49.5 is still looking like a net credit. So 49.55, pretty strong probability that we'll get filled here. If the stock falls down to 48.50, we're going to sell those shares, buy those contracts back for whatever the market price is at that moment. Now, we don't know what that could be, so we have to be familiar with that risk. Let's click confirm and send. Buying the 2 covered calls with a 49.55 limit, selling if BAC falls to or below 48.50. A few important reminders down here. Due to potentially wide markets or liquidity risks at the time of activation of the stop order, that conditional sell order, this order may manually be substituted with a limit order upon activation and worked until filled. There's a reminder here. Please note you've selected a weekly option series, October 10th versus October 17th would be the standard third Friday option series with a non-standard expiration date. With stop orders, there's no guarantee that the execution price will be equal to or near the activation price. So this thing could be falling hard. It could blast right through 48.50, and we might sell a stock at a lower price than maybe we were planning. All right, but let's send this order off. And we're in. All right. So there we go. So there are pros and cons to selling covered calls on lower priced stocks. We've talked through some of those pros being, hey, it's a lower priced stock and they are very commonly associated with relatively higher premiums or comparatively strong premiums, even when compared to what traders might think of as the traditionally more volatile stocks with traditionally more with traditionally higher premiums. We have planned and placed an example trade, but I do want to go have a look at the current positions in the portfolio. Let's go see what's going on with those. We have 5 other positions here. So, well, you know what? Let me just double check something here. I'm going to have to go repeat that trade, put it into our covered calls. I just routed that into our example IRA account. That's something you want to keep an eye on when you're placing trades at home. It's easy to get a little bit dismissive about the reality of things when we're in paper money. Yeah, just make sure that we route those to the correct account. But in any case, we have 5 current positions in our covered calls and short puts portfolio. We have Apple, NEE, Tesla, Visa, and Walmart. So let's see what's going on with each of these. So with Apple, we have a couple that have gone in the money. So with Apple, we actually bought the stock. We were assigned the stock after selling a short put back here. Sold the 235 put. It was assigned at 235. Right now, we're in an obligation to sell those shares for 225. Oh no, we're probably going to lose $10 per share on the stock. Yep. But along the way, we've collected $3 in premium for a profit, $1.49 for a profit, 80 cents profit, 225 profit, 165 profit, 133 profit. And if we get assigned, that would be a realized gain on our most recent contract of another $1.14. The break even on this trade net is actually down at 223.24 after all of these premiums we've collected along the way. So yeah, even though we might wind up selling these shares $10 less than what we paid for them, we've made $11.76, or I'll say made as if the contract were already assigned. Yeah, if this most recent contract were assigned, we'd actually make $11.76. Pardon me, $1.76 after the $10 loss on the stock, minus commissions. E. Dunny says, would you consider rolling out that call? I would. Yeah, that's one of the things that a trader can consider, but I'm not going to this time. I think I want to see what happens. I think it's probably, Susie says, how do I get the Thinkorswim software? Oh, Susie, yeah, good question. If this is your first time in one of our webcasts, welcome. Great to have you here. Thinkorswim can just be downloaded free of charge from within your Schwab online account. You just go up to the Trade tab, log into Schwab, go up to the Trade tab, and in the pop-down menu, you'll see Thinkorswim. So you just click on that, and you'll see a big blue button that will guide you through the process of downloading Thinkorswim. Okay? Yeah, that doesn't cost anything. Anyway, yeah, good question. Could we roll this? Yep, the trader might consider rolling. Obviously, there's still the consideration of can we get the order filled? But assuming we have a good liquid contract, and we're able to maybe buy out of the current contract and sell another one, trader might consider doing that. That would realize a loss. So rather than having a realized gain on this 19th of September contract, that would probably realize a loss. And then if we got a reversal in the stock, it's going to raise the break-even point on this trade, could expose us to additional risk. There are pros and cons. I'm not going to do that today. For today, we're going to let Apple, we're going to let it go. It'll very likely be assigned. It's not going to be assigned before expiration. In paper money, early assignment's not a thing. In real life, it is a thing. Could certainly happen. Tesla is in a similar position. You'll see ITM. This one's also in the money. Here's what's going on with Tesla. So Apple, if we get called out, profitable trade, done. Okay. With Tesla, we bought our shares down here at 233. Right now, we have an obligation to sell those shares at 365. So if this call gets assigned, and it probably will, we're going to realize a $132 profit per share finally on these Tesla shares. Now that's great. It's not as great as it could have been, because you notice if the stock is up here at 407 and we have to sell for 365, that's great, but we might have done better by not selling this particular call. You just never know that. That's sort of the benefit of hindsight. But bottom line is, if we get assigned, we make about $132 on the stock. That's a banked profit. Plus, we've collected profits on premiums along the way, including this one would be a realized gain, an additional gain of $775. That would be a great trade. Our break even's actually all the way down here at around $200 per share. We're literally double break even at this moment. So I'm going to let that one just go to expiration. We do have a couple of others though here. I do think we're going to roll. We have NEE and we have Visa. So with NextEra, we own 200 shares. We've sold the $75 call for the 19th of September. The stock's only around 72, and that call is only worth about 10 cents. We collected 112 when we sold it. So we might be able to get out for just 10 cents, realize about 90% of the original maximum premium here. S says, are there any particular factors to take into account when deciding whether to have the stock taken away from us or to roll the option over? Yes, there can be. Yeah. Let me hit the pause button on what we're going to be doing with NextEra. Let's maybe go back here to Tesla. Okay. Now I can't get into tax implications. So if the trader has tax motivations for keeping or selling the stock, that's up to them. This is not something I can discuss, but that can be a consideration. So be aware of that. But let's say that the trader just wants to keep the shares. Well, if we were to buy out of this 19th of September 365 call, if we buy out of that, we no longer have an obligation to sell the shares for 365. Awesome. Now we own the shares for 407 or at 407, still way above what we paid for those, and sky's the limit from there. The problem is, to buy out of this 19th of September call is going to cost at least $42 because this contract is $42 in the money at the moment. Probably going to cost right around that, maybe a little bit more depending on any time value. We only got about $8 for it. So that would be a realized loss of about $34 per share on that contract. When I say, well, that's okay, because that allows us to keep the shares that are now worth 407. We no longer have to sell those for 365. So we're getting a benefit for spending that money. Yeah, but if we don't sell the shares and the stock collapses, now we spent the money to get out of the obligation and the shares are now misbehaving. It's possible that that our stock could turn on us here. So one thing the trader might consider is, do they want to continue with stock ownership at the cost required? Now, obviously, another thing they might consider doing is buy out of that call, sell one at a higher strike. That might help to offset the cost of exit on this kind of expensive one now, but it also imposes another limit on the stock price. So there are pros and cons. Pathik Shah says, Cameron, do you have to take profit and stop loss already set up? What is that thing on the chart? I don't know what you're referring to as that thing. You don't have to take profit, don't have to take losses before expiration unless we're assigned. We have the ability to make the decisions for ourselves. But I did already set up a stop on the other trade, if you got to see that one. Anyway, yeah, I'm going to let this one go to expiration. We need to get to these other trades here. With this one, how about we roll this one? It's literally only 10% of the original price collected. All those dotted blue lines, I drew those on there. I literally just drew them on. Okay, so it's not like a special thing that you would have to enable or something that puts it on automatically. I just drew those lines on those boxes and stuff like that. Let's see. Let's go to our chart of NEE. So there is our 19th of September $75 call, and you can see the stock is pulled down, starting to bounce. Let's see if maybe we can roll this. Could we just roll it out, keep it at 75 and move it out to October 17th? Let's go have a look. Go to the trade tab. Wait a minute, is there an earnings announcement? Nope, not on NEE. 17th of October. If we keep it there at 75, looks like there's about another $1 that we might be able to sell this for. So if it costs us, let's say 10 cents to get out of the current contract, and we can roll that out for $1 to the 17th of October, maybe we net about another 90-cent credit there. How about we do that? Let's go to our monitor tab. I'm going to right click on that call and create a rolling order. And so this is in order to buy the $75 contract that we're in for the 19th of September. And then we're going to sell the $75 contract. Let's put that out to the 17th of October. We might be able to get about an 87-cent credit. Let's say that we're willing to settle for an 85-cent credit here. Okay, let's click confirm and send. Now this is going to describe this as a calendar. Basically, that's saying that we're doing two contracts at the same strike price with different expirations. But yeah, we're just buying out of the September, trying to sell the October. If we can do that, generate a credit. Let's send that order off. But there is a commission to be paid on both sides. Let's click send. See if we can get that one filled. I'll let that trade work. That's right up here. Looks like we're asking for an 85-cent credit. The mark is essentially offering an 89-cent credit. I think there's a good likelihood that'll fill here pretty quickly. And finally, we have Visa. Is there an earnings announcement on Visa? Here's the call that we previously sold. Oh, looks like we filled for 86 cents on that one. Okay. Visa's been kind of chopping around. We've decided we're going to exit this position if the support breaks. It hasn't broken yet. We do have, as we go to Visa, you can see here, we have an order to get out of our covered call. If we change the strike price here, we'd have to modify that order. I don't want to rush that. Let's leave this. No, that's only four days away. Can't wait till next week. So here's what I'm going to do. Let's right click here, cancel this order. And then for Visa, let's roll that out. And let's see, can we keep it also at a similar strike? I don't know if we're going to get much for 360. We might need to come down here to, let's say, 355. Somewhere in that neighborhood. So let's go to our trade tab. Not our trade tab. Let's do this from our monitor tab. Right click on the call option, create a rolling order. This is to buy out of the 360. Let's do a 355 for 17th of October. That looks like that might be around a 285 credit. Let's say we're willing to settle for a 280 credit. All right, so here's what we're doing. Bringing in another credit, great, but we now have an extended obligation out to the 17th of October. Someone has the right to buy our shares from us for 355 rather than 360. Those 360 calls right now only worth 12 cents. So that would be realizing a gain of nearly $3 there if we're able to get that order filled. So let's confirm and send. Looking for a credit of 280 minus the commission. Net credit of 278.70 is the minimum here that we're looking for to buy out of the 19th of September 360 and roll that to the 17th of October 355. Let's send that order off. And we'll see if we can get that one filled. But guys, we've accomplished what I set out to do today. I wanted to have this discussion. What about selling covered calls on low price securities? For some traders, it can certainly be worth it. Obviously, there are pros and cons to each approach. So we just have to weigh those risks and benefits and make an informed decision. But everybody, thanks for giving me your time today. I'm going to let you go enjoy the rest of our educational offerings. But as you do, remember that we have other resources available for you from Schwab Education outside of these live streams. First of all, make sure, if you haven't done this already, make sure that you have subscribed to our Trader Talks channel. That's a YouTube channel. Full name of the channel is Trader Talks Schwab Coaching Webcasts. You can subscribe by going down the lower right-hand corner, click on that subscribe button. It literally only takes a second. It doesn't cost anything. But this is where we house our playlists of previous webcasts. You can join our live streams here. You can also do keyword searches for maybe topics of specific interest. But for example, if you wanted to find last week's discussion, you go to playlists on our channel. Scroll down. There are lots of different webcast series that we have running. Mine, the playlist is about third row up from the bottom. Trading covered calls and short puts. You click on view full playlists. And there's last week's discussion. Is it easy to make monthly income by selling options? Let's talk about that. All right. Also, if you're not following Brent and me on X, I would suggest you do that. It's the best place to connect with us in between these live streams. You can find Brent on X at Brent Morris CS. You can find me there at Cameron May CS. And this is where we can make those connections in between live streams when the camera's not on. So for example, I just threw out this question this morning. Hey traders, what in the world is this thing on a chart? What name would we give this? And people are starting to give me their responses. And I'll just, when you reply to one of my posts, I try to reply right back to you. So additional learning that can be had there. Definitely give us a follow. Guys, go have a great day. I will see you tomorrow. Brent, thanks for helping out in chats. I can see 131 people watching the live stream and 53 have already clicked the thumbs up. That's always appreciated. That gives a boost to your presenters webcast in the YouTube algorithm. Also, it's a nice pat on the back. So hopefully you have that habit of when you enjoyed one of our webcasts, click the thumbs up. All right, everybody, see you tomorrow or next week. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.